There is a secret that separates the architects of generational wealth from the gamblers who litter the stock market. It's not a complex formula hidden in an algorithm, nor is it a whisper of insider information shared in an oak-paneled boardroom. It is a sign, a simple, almost primitive signal of intent that, once you learn to see it, will change the way you invest forever. It is the dividing line between entrusting your hard-earned capital to a partner and handing it over to a hired hand. Warren Buffett, the master of this craft, has spent a lifetime not just analyzing balance sheets, but analyzing the souls of the people who command them. He understood that the most important number on any financial statement is the one that isn't there, the character and mindset of the chief executive officer. Most investors, from the novice retail investor to the seasoned fund manager, make a catastrophic error. They fall for the celebrity CEO, the charismatic visionary on the cover of magazines, the smooth-talking operator on financial news networks, the one who promises disruption and paradigm shifts. They invest in the story, in the persona, not the substance, and in doing so they walk directly into a trap. This trap is sprung by the CEO, who is merely a manager, a temporary custodian of capital, whose primary objective is not the long-term flourishing of the business, but the short-term inflation of its stock price to maximize their own bonus, their own stock options, their own golden parachute. They are playing a different game than you are. You are investing for a decade, for your retirement, for financial freedom. They are managing for the next quarter, for the next earnings call, for their next contract negotiation. This fundamental misalignment of interests is the unseen cancer in countless portfolios. But there is another way. There is a class of leader who views the company not as a stepping stone, but as their life's work. They think in terms of decades, not quarters. They see the company's capital not as a budget to be spent, but as their own family's savings to be nurtured and compounded. They act like owners. And learning to identify these owner CEOs is the single most powerful upgrade you can make to your investment due diligence process. It transforms stock analysis from a gamble on market sentiment into a partnership with proven value creators. It is the key to unlocking true, sustainable, long-term wealth. This is not about timing the market. It is about aligning yourself with the forces of rational, patient, and relentless value creation. This is the final promise, that by the end of our time together, you will possess the mental framework to distinguish the manager from the owner, to shield your capital from the short-term gamblers, and to place it in the hands of those who will treat it as you would, with a sacred duty to make it grow. The first and most crucial test, the absolute acid test of a CEO's mindset, lies in how they handle the lifeblood of the business, its capital. The discipline of capital allocation is not just one of a CEO's jobs. According to Warren Buffett, it is the most important job. An owner CEO understands that every dollar of profit belongs to the shareholders. That dollar can be reinvested back into the business, used to acquire another business, pay down debt, buy back stock, or be paid out as a dividend. These 5 choices are the only 5 choices, and the wisdom with which a CEO makes them over time determines nearly all of the long-term value created for shareholders. A manager sees a pile of cash on the balance sheet and thinks, "What can I buy with this?" An owner sees that same pile of cash and thinks, "What is the highest possible return I can get for my partners on this dollar? And if I can't find a truly great opportunity, I will give it back to them." This distinction is everything. It is the fundamental dividing line between stewardship and empire building. To truly understand this principle in action, we must travel back to the 1960s and meet a man who was, in Buffett's own words, the greatest capital allocator he ever knew. His name was Tom Murphy, the CEO of a small, obscure television company called Capital Cities Broadcasting. Murphy was not a celebrity. He did not seek the limelight. What he sought, with a relentless and fanatical devotion, was value. His story is not just a lesson in business acumen, it is a masterclass in the owner's mindset. Capital Cities was a tiny operation, but Murphy ran it with an almost painful frugality. He shared a secretary with his chief financial officer. He reused paper clips and wrote on the back of old memos. This wasn't for show. It was because he viscerally felt that every dollar wasted was a dollar stolen from his partners, the shareholders. This frugality was the outward manifestation of a deep-seated discipline in his capital allocation. For years, Murphy and his partner, Dan Burke, methodically acquired small television and radio stations, never overpaying, always demanding a high return on their investment. They built their company, brick by brick, dollar by rational dollar. Then, in 1985, they did something that shocked the financial world. Tiny capital cities, with revenues of just over $1 billion, announced it was acquiring a titan of American media, the American Broadcasting Company, or ABC. ABC was a Goliath, with revenues nearly 3 times that of capital cities. The deal was valued at an astounding $3.5 billion. On the surface, it looked like a minnow swallowing a whale, a classic case of a CEO's ego run amok. The market was skeptical. Wall Street analysts whispered that Murphy had finally overreached, that his ambition had gotten the better of his discipline. But they misunderstood the man. They saw a manager trying to build an empire. Buffett saw an owner seizing a once-in-a-generation opportunity. Murphy wasn't buying ABC for the glamour or the prestige. He had done the math. He understood that the broadcast networks, despite their bloated cost structures, were magnificent cash-generating machines protected by a massive competitive moat. He saw that ABC was being run like a bureaucratic fiefdom, not a business. He knew that by applying his and Dan Burke's famously lean, decentralized, and rational management style, he could dramatically increase ABC's profitability. He wasn't just buying a company, he was buying a mountain of unrealized potential at a rational price. The financing for the deal was a work of art in itself, a testament to his reputation. To fund the purchase, Murphy turned to one man he knew thought just like him, Warren Buffett. Buffett's Berkshire Hathaway invested over $500 million to help finance the acquisition, a massive sum for Berkshire at the time. Why? Because Buffett wasn't betting on the television industry. He was betting on the proven shareholder alignment and brilliant capital allocation skills of Tom Murphy. He knew his capital was in the hands of a true owner. The result was legendary. Murphy and Burke swiftly implemented their disciplined operational style at ABC, cutting waste, empowering managers, and focusing on profitability. The combined company, Capital Cities/ABC, became a powerhouse, and the returns for shareholders who had trusted Murphy were astronomical. By the time the company was sold to Disney a decade later for $19 billion, that initial $3.5 billion investment had compounded into a fortune, making countless investors wealthy. Tom Murphy's career is the foundational anecdote for this pillar, because it demonstrates that great capital allocation isn't about splashy, ego-driven deals. It is about a patient, rational, and relentless focus on maximizing the long-term per-share value of the business. It's a mindset that is rare, powerful, and incredibly profitable for those who can identify it. The reason Tom Murphy's approach is so rare and so effective can be explained by a powerful psychological principle, loss aversion. Coined by psychologists Daniel Kahneman and Amos Tversky, loss aversion is the cognitive bias that describes how, for most people, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This simple asymmetry in our emotional response to outcomes has profound implications for corporate decision-making. A true owner-CEO like Tom Murphy or Warren Buffett feels loss aversion with every dollar of corporate capital because, in their mind, it is asterisk their money. A dollar spent on a foolish acquisition, an overpriced piece of equipment, or a wasteful corporate perk registers in their brain with the same painful sting as if they had taken it from their own wallet. This intense personal connection to the capital creates a powerful psychological barrier against wasteful or speculative behavior. It forces a level of due diligence and discipline that is almost impossible to replicate for someone who doesn't feel that same sense of ownership. Now consider the typical manager CEO, They are a hired hand. The capital they are allocating is an abstract figure on a spreadsheet, labeled corporate budget or M&A war chest. They are intellectually aware that this money belongs to the shareholders, but they do not feel its potential loss in their gut. When they make a decision, they are not weighing the personal pain of loss against the potential for gain. Instead, their decision-making calculus is dominated by other, more powerful psychological forces. One of these is social proof, or herd bias. If CEOs of other large companies are all making acquisitions in a hot sector, the manager CEO feels immense pressure to do the same, lest they be seen as falling behind. The fear of missing out, of being the one leader who didn't get in on the action, often outweighs a rational analysis of the deal's merits. Another is the incentive-caused bias, which we will explore in more detail later. If their bonus is tied to growing the company's revenue or market share, they will be psychologically primed to pursue growth at any cost, even if it means making acquisitions that destroy shareholder value. The desire for the reward short-circuits the rational process of capital allocation. The manager CEO is playing with house money, and their psychological framework reflects that. The owner CEO is playing with their own life savings, and their every move is dictated by the primal fear of losing it. This difference in psychological orientation is the invisible engine driving the vastly different long-term results between companies run by owners and those run by managers. Understanding loss aversion allows you, the retail investor, to look past the CEO's words and analyze their actions through a new lens. Are their decisions characterized by a deep-seated fear of permanent capital loss, or by a cavalier willingness to follow the herd and chase growth for its own sake? The answer reveals everything about their true allegiance. So how do you, as an investor performing your own due diligence, translate this theory into a practical tool for stock analysis? You need an applied mental model, a blueprint for dissecting a CEO's capital allocation decisions. Let's call it the 5 uses of cash framework. When a company generates $1 of profit, that dollar belongs to you, the shareholder. The CEO is your employee, tasked with deploying that dollar on your behalf. There are only 5 things they can do with it. Your job is to grade their decisions over the past 5 to 10 years. First, they can reinvest it into the core business. This is usually the best option, provided the business can generate high returns on that incremental capital. You need to ask, is the CEO investing in projects that widen the company's competitive moat? Are they spending on R&D that leads to better products? Are they building new factories that will be highly profitable? You can find clues in the company's financial statements by looking at capital expenditures and comparing the growth in capital invested to the growth in operating earnings. A great CEO, an owner CEO, will only reinvest $1 if they are confident it will generate more than $1 of value in the future. Second, they can acquire other businesses. This is the most dangerous use of cash, as most acquisitions fail to create value for the acquiring company's shareholders. Here, your due diligence is critical. Look at the company's acquisition history. Did they pay a reasonable price? Was the acquired company in a business they understood, or was it a diversification into a new unfamiliar field? Did the acquisition actually lead to higher profits and returns on capital in the years that followed? An owner CEO like Tom Murphy makes rare, large, and strategically brilliant acquisitions. A manager CEO often makes frequent, small, and strategically incoherent acquisitions to simply grow the size of their empire. Third, they can pay down debt. This is often a prudent and responsible use of cash, especially if the company is over-leveraged. It strengthens the balance sheet and reduces risk. An owner CEO understands that debt is a dangerous tool and is keen to reduce it when times are good. A manager CEO might be tempted to carry high levels of debt to juice short-term returns on equity, a risky gamble that can be fatal in a downturn. Fourth, they can buy back their own stock. This can be a wonderful use of cash, times if and only if the stock is trading below its intrinsic value. When an owner CEO believes their company's stock is cheap, they will enthusiastically buy back shares, effectively increasing each remaining shareholder's stake in the business at a bargain price. A manager CEO, however, often buys back stock for the wrong reasons. They do it to offset the dilution from their own stock option grants. Or, even worse, they buy back shares at record high prices simply to prop up the stock and hit a performance target for their bonus. You must analyze when they buy back stock. Is it opportunistically when the price is low, or consistently regardless of valuation? The timing reveals their motivation. Fifth, and finally, they can pay a dividend. If the CEO cannot find any high-return opportunities in the first four categories, the final and most disciplined option is to return the cash to the owners, the shareholders, in the form of a dividend. This is an admission that you, the investor, can likely find a better use for that capital than they can. It is an act of supreme shareholder alignment. An owner CEO is not afraid to say, "We have no brilliant ideas right now, so here is your money back." A manager CEO hates paying dividends because it reduces the size of the empire they control. By systematically analyzing a company's history through this five-part framework, you create a scorecard for the CEO's capital allocation skill. You move beyond their words and promises and judge them on their actions. This is the core of quality investing and management analysis. This blueprint allows any retail investor to think like Buffett and evaluate a CEO's most important job with clarity and confidence. To fully appreciate the genius of the owner-CEO's approach to capital allocation, we must explore its opposite. We must walk the path of the 99%, the well-trodden road of value destruction paved with the good intentions of manager CEOs. This is the world of the empire builder. The empire builder CEO is often charismatic, celebrated, and universally admired by the financial press. They are lauded for their vision and their boldness. But their primary, often unconscious motivation is not to increase per-share value for the owners, but to increase the size, scope, and prestige of the company they manage. Why? Because executive compensation, power, and public acclaim are all highly correlated with the size of the company a CEO runs. A bigger company means a bigger paycheck, a bigger office, a bigger jet, and a bigger photo in the annual report. This creates a perverse incentive to grow at all costs, even if that growth is unprofitable and ultimately destroys the wealth of the very shareholders they are supposed to serve. The most infamous example of this destructive mindset is the calamitous merger of AOL and Time Warner in the year 2000. At the height of the dot-com bubble, Steve Case, the CEO of AOL, was the king of the new internet economy. He was the ultimate celebrity CEO, a visionary who had brought America online. Gerald Levin, the CEO of Time Warner, was the head of an old media behemoth, desperate to prove that his company was not a dinosaur destined for extinction. The two men, driven by ego and a desire to create the biggest media company in the world, concocted a deal. AOL would acquire Time Warner for an astronomical $164 billion. The rhetoric was intoxicating. They promised a new era of synergy, a convergence of old and new media that would dominate the 21st century. The market, caught in the mania of the times, ate it up. But a true owner, a rational capital allocator, would have seen the flashing red lights. AOL's valuation was based not on profits, but on eyeballs and clicks, a bubble of speculative fever. Time Warner, while a solid collection of assets, was a complex and bureaucratic organization. The idea that these two vastly different cultures could merge seamlessly and create trillions in new value was a fantasy. An owner's CEO would have looked at the price tag and run for the hills, but Steve Case and Gerald Levin were empire builders. They were focused on the deal, the headlines, the legacy. They were not focused on a rational calculation of intrinsic value. The result was arguably the single worst acquisition in corporate history. The promised synergies never materialized. The cultures clashed violently. The dot-com bubble burst, and AOL's valuation evaporated. The combined company, AOL Time Warner, was forced to take a goodwill write-down of nearly $100 billion just 2 years later, an accounting admission that the deal had been a catastrophic failure. Trillions of dollars of shareholder wealth were vaporized. Careers were ruined. The deal became a textbook case of value destruction driven by CEO ego. This is the path of the 99%. It is the pursuit of growth over profitability, of size over value, of deals over discipline. It is what happens when a manager's desire for empire trumps an owner's duty to their partners. The retail investor who learns to spot the signs of the empire builder, the constant talk of transformational deals, the focus on size and scale over per-share metrics, the willingness to pay any price to win a bidding war, can sidestep these train wrecks and preserve their capital for more rational endeavors. The difference between the owner's disciplined capital allocation and the manager's empire building is not just a philosophical one. It manifests directly and powerfully on a company's financial statements and in your investment portfolio. The direct financial connection is undeniable and quantifiable. Let's consider a company that generates $100 million in free cash flow. An owner-CEO, a master of capital allocation, will take that $100 million and deploy it with an owner's mindset. Let's say they find an opportunity to reinvest it into their business, perhaps by building a new, more efficient factory that will generate a 20% return on invested capital. That $100 million investment will now produce an additional $20 million in operating profit each year, year after year. This flows directly to the bottom line, increasing the intrinsic value of the entire business. Over a decade, that single decision, compounded, can add hundreds of millions of dollars to the company's market capitalization. Alternatively, if they can't find a high-return internal project, they might see that their company's stock is trading at a significant discount to its intrinsic value. By using the $100 million to buy back their own shares, they effectively reduce the number of shares outstanding, making each remaining share more valuable. This directly increases earnings per share, a key metric watched by the market. This is manufacturing value for the owners. Now let's look at the manager-CEO, the empire builder. They take that same $100 million in free cash flow. Driven by the need to show growth, they acquire a competitor in a flashy, headline-grabbing deal. Because they are more focused on winning the deal than on the price they pay, they overpay. They acquire the company for a price that will only allow them to generate a 5% return on their investment. That $100 million now only generates $5 million in additional operating profit. They have taken a valuable resource, your cash, and deployed it at a subpar rate of return. Worse, they often have to take on significant debt to finance the deal and incur massive integration costs, further eroding value. On the balance sheet, you will see the goodwill account balloon. Goodwill is an accounting plug, essentially the premium paid for an asset above its tangible value. In the hands of an empire builder, the goodwill account often becomes a graveyard for shareholder capital, a monument to ego-driven acquisitions that will eventually have to be written down, just as AOL Time Warner did. The long-term result is a bloated, inefficient company with low returns on capital. The stock may pop briefly on the announcement of the bold acquisition, but over time, as the poor economics of the deal become apparent, the stock will languish. The difference is stark. The owner-CEO's actions lead to a rising return on invested capital, ROIC, a clean balance sheet, and a steadily compounding stock price. The manager-CEO's actions lead to a declining ROIC, a goodwill-laden balance sheet, and a stagnant or declining stock price. By learning to analyze capital allocation, you are learning to read the financial tea leaves that predict long-term success or failure. It is the most critical component of leadership and business acumen, and it is the first and most important sign of a CEO who will make you rich. The second great pillar in our framework for identifying the owner-CEO is perhaps the most direct and revealing of all: the structure of their compensation. Nothing exposes a leader's true priorities and allegiances more clearly than the way they are paid. As the eternally wise Charlie Munger, Buffett's partner, famously said, "Show me the incentive and I will show you the outcome." This is not cynicism. It is a fundamental law of human nature. The design of executive compensation is the DNA of corporate governance. It dictates behavior, shapes strategy, and ultimately determines whether the CEO's interests are aligned with yours, the shareholder, or are actively working against them. An owner's CEO's compensation is elegantly simple and powerfully aligned. Their financial success is almost entirely tied to the long-term appreciation of the business itself, through direct and significant stock ownership. A manager CEO's compensation is a complex web of bonuses, options, and performance grants, often designed to reward short-term metrics that have little to do with the creation of genuine, lasting value. The ultimate foundational anecdote for this principle is, of course, Warren Buffett himself. His compensation arrangement at Berkshire Hathaway is a masterclass in shareholder alignment. For decades, his annual salary has been a mere $100,000. He takes no bonuses. He receives no stock options. In a world where CEO pay packages regularly soar into the tens or even hundreds of millions of dollars, Buffett's salary is a rounding error. So how did he become one of the wealthiest people on the planet? Through ownership. His vast fortune comes from one source and one source only: the rising value of his enormous holding of Berkshire Hathaway stock. His financial interests are not just aligned with his shareholders, they are identical. When Berkshire's intrinsic value increases, his wealth increases. When Berkshire makes a mistake and its value suffers, his personal net worth suffers far more than any other shareholder. He eats his own cooking, and he has been doing it for over half a century. This isn't just a folksy quirk of the Oracle of Omaha. It's a deliberate and profound statement of principle. By refusing stock options, Buffett avoids a classic trap. Stock options are a one-way bet for an executive. If the stock goes up, they make a fortune. If the stock goes down, they lose nothing. This heads I win, tails you lose structure can encourage reckless, go-for-broke risk-taking with shareholder capital. Buffett wants to feel the pain of a bad decision just as acutely as his partners, which is why he insists on owning stock outright. Furthermore, by keeping his salary low, he sends a powerful cultural message that permeates the entire organization. At Berkshire, the focus is on building the business, not on enriching management. This philosophy extends to the CEOs of the dozens of companies Berkshire owns. Buffett looks for leaders who are already rich, who are motivated by a love for their business, not by the desire for an ever larger paycheck. Contrast this with the typical CEO compensation plan in corporate America. It is often a document of Byzantine complexity, drafted by highly paid consultants with the implicit goal of maximizing executive pay, while providing the thinnest veneer of pay for performance. You'll see salaries in the millions, cash bonuses tied to hitting quarterly earnings per share targets, and massive grants of stock options and restricted stock units tied to the company's stock price performance relative to a peer group over a 1- or 3-year period. Every single one of these mechanisms can be, and often is, gamed. They incentivize short-term thinking and financial engineering over long-term value creation. Buffett's simple, ownership-based model is the North Star. It is the gold standard of shareholder alignment. It ensures that the CEO wakes up every morning thinking not about their bonus, but about how to increase the enduring value of the enterprise, the very same thing you, as a long-term investor, care about. The immense power of incentives to shape behavior is rooted in a deep and predictable feature of human psychology: incentive-caused bias. This is the idea that our brains are not perfectly rational calculating machines. We are heavily, and often unconsciously, influenced by the reward systems we operate within. When a person is offered a reward for achieving a certain metric, their brain will begin to rationalize and justify any and all actions that help them achieve that metric, even if those actions are detrimental to a larger, more important goal. It's not that most CEOs are consciously malicious. It's that their cognitive frameworks are hijacked by the compensation plans they are given. As Upton Sinclair Riley noted, it is difficult to get a man to understand something, when his salary depends on his not understanding it. Let's break down how this works on a cerebral level. Imagine a manager CEO whose annual bonus is heavily weighted on achieving a specific earnings per share or EPS target for the fourth quarter. As the quarter nears its end, it becomes clear the company is going to miss the target by a few cents. This triggers a powerful threat response in the CEO's brain. The promised reward, a multi-million-dollar bonus, is about to be lost. The pain of this potential loss, thanks to loss aversion, is intense. This emotional pressure activates the more primitive parts of the brain, overriding the slower, more rational prefrontal cortex. The CEO's mind begins to search desperately for a solution, any solution, to close the gap. Suddenly, actions that would have seemed unwise or even unethical in a calmer moment begin to seem perfectly reasonable. For instance, they could slash the research and development budget for the quarter. This instantly boosts profits and helps them hit the EPS target. The long-term damage to the company's competitive position is a distant, abstract problem. The immediate, tangible reward of the bonus is right here, right now. This is temporal discounting in action, our tendency to prefer smaller, sooner rewards over larger, later ones. Or they might pressure their sales team to stuff the channel, offering huge discounts to distributors to buy more product than they need, effectively pulling sales forward from the next quarter into this one. This makes the current quarter's numbers look great, but it guarantees a weak start to the next year and can damage relationships with distributors. Again, the short-term incentive overwhelms long-term business logic. Incentive-caused bias explains why a CEO might use billions in corporate cash to buy back stock at an all-time high. It's not because they think it's a great long-term investment. It's because the buyback reduces the number of shares outstanding, which artificially inflates EPS and helps them trigger a performance bonus. The compensation structure literally forces them to make a poor capital allocation decision. An owner-CEO whose wealth is tied to the long-term value of their stock is largely immune to these short-term pressures. A temporary dip in quarterly EPS means little to them. Slashing the R&D budget would feel like cutting off their own arm to save a finger. An act of self-mutilation. They are playing a long game, and their psychological incentives are aligned with that game. By understanding incentive-caused bias, you can learn to see executive compensation plans not as boring legal documents, but as psychological blueprints that predict the future behavior of the CEO. To weaponize this understanding, you need a practical tool, an applied mental model for dissecting and grading a company's executive compensation structure. We'll call it the Executive Compensation Scorecard. This is a checklist that any retail investor can use when reviewing a company's annual proxy statement, the DEF 14A filing, which is where all the details of executive pay are disclosed. It can feel intimidating, but with this scorecard, you can cut through the noise and find the signal. First, check the salary-to-ownership ratio. Is the CEO's primary source of wealth their salary and bonus, or their ownership stake in the company? Look for a low base salary relative to their stock holdings. A high salary makes a CEO feel like a well-paid employee. A massive stock holding makes them feel like an owner. Ideally, the CEO should have purchased a significant portion of their shares on the open market with their own money, not just received them as grants. This demonstrates true skin in the game. Second, analyze the performance metrics. What specifically does the CEO have to do to earn their bonus and equity grants? Look for metrics tied to the long-term health and profitability of the business, not the short-term fluctuations of the stock price. Excellent metrics include return on invested capital, ROIC, growth in intrinsic value per share, which some rare companies like Berkshire actually calculate, or other operational measures of business quality. Be extremely wary of metrics like total shareholder return, TSR, or EPS growth. TSR can be juiced by market sentiment and has little to do with the CEO's operational skill. EPS can be easily manipulated through buybacks and accounting tricks. Third, examine the time horizon. Over what period is performance measured? An annual bonus plan encourages annual thinking. Look for long-term incentive plans, LTIPs, that measure performance over 3, 5, or even 10 years. The longer the time horizon, the more likely the CEO is to make decisions that benefit the long-term health of the business. Also, check for long holding periods. Is the CEO required to hold the stock they receive for many years after it vests? This ensures they have to live with the long-term consequences of their decisions. Fourth, scrutinize for soft or discretionary bonuses. Many compensation plans include a large component that is awarded at the discretion of the board's compensation committee. This is often a red flag. It can be a way to reward a CEO for simply showing up, regardless of actual performance. Look for clear, objective, and challenging performance hurdles. Fifth, and finally, look for simplicity and clarity. An owner-CEO's compensation plan should be simple enough for a typical shareholder to understand. If the proxy statement contains dozens of pages of complex formulas, convoluted peer group comparisons, and legalese, it is often a sign that the plan is designed to obscure rather than to clarify, to guarantee a payout rather than to incentivize true performance. A simple plan, low salary, large stock ownership, and a long-term bonus tied to a key measure of business value is the hallmark of true shareholder alignment. Using this scorecard transforms the act of reading a proxy statement from a chore into a powerful exercise in management analysis. It's your personal due diligence tool for finding CEOs who are paid to think like you. To fully grasp the wisdom of an aligned compensation structure, we must examine its dark reflection, the path of the stock option gambler. This is the CEO whose compensation is overwhelmingly dominated by short-term stock options. This structure doesn't just misalign interests, it creates a powerful incentive for the CEO to treat the company as their personal casino, using shareholder capital to make highly leveraged bets on the stock price. They are not trying to build a durable business. They are trying to engineer a short-term spike in the stock price to coincide with the vesting of their options. This is the path of the 99% of compensation plans, and it is paved with corporate wreckage. A classic and tragic example of the stock option gambler is Chainsaw Al Dunlap, the infamous CEO of Sunbeam in the mid-1990s. Dunlap was a corporate celebrity, a self-proclaimed turnaround artist known for his ruthless cost-cutting and mass layoffs, which earned him his grisly nickname. He was hired to rescue the struggling appliance maker, and the board gave him a compensation package that was pure rocket fuel for reckless behavior. He received a massive grant of stock options that would be worth a fortune if, and only if, he could get Sunbeam's stock price to rise dramatically and quickly. Dunlap's interests were not aligned with long-term shareholders, employees, or customers. His interest was in creating the illusion of a miraculous turnaround just long enough to cash in his options. What followed was a textbook case of incentive-caused bias leading to corporate destruction. He immediately fired half the workforce and closed numerous factories. This provided a short-term boost to profits, and the stock began to rise. Wall Street, enamored with his tough guy persona, applauded his decisive leadership. But this was just the beginning. To keep the momentum going, Dunlap and his team engaged in a massive accounting fraud. They used the channel stuffing technique we discussed earlier on an epic scale, forcing retailers to buy millions of dollars of barbecue grills and other seasonal products months before they were needed. This created phantom sales and phantom profits. They also used a bill-and-hold strategy, booking revenue for products that were sold but never actually shipped to the customer, instead being stored in third-party warehouses. For a brief period, the illusion worked. Sunbeam's reported earnings soared, and the stock price shot up from around $12 to over $50 a share. Al Dunlap was on the cover of magazines, hailed as a management genius. He cashed in his options, making over $100 million. But the whole thing was a house of cards. Eventually, you run out of accounting tricks. The next year, retailers, already swamped with inventory, stopped ordering. The sales and profits collapsed. The accounting fraud was uncovered by the press and regulators. The stock price crashed, wiping out investors and ultimately forcing the company into bankruptcy. Al Dunlap walked away a very rich man, leaving behind a ruined company, thousands of unemployed workers, and investors who had lost everything. This is the ultimate danger of the stock option gambler. The compensation structure incentivized the destruction of the very business the CEO was hired to save. It rewarded a short-term illusion over long-term reality. The retail investor who learns to spot these compensation packages, those heavily reliant on short-term options, tied to malleable metrics like EPS and lacking any clawback provisions or long holding periods, can avoid becoming collateral damage in a CEO's personal get-rich-quick scheme. The direct financial connection between executive compensation and shareholder returns is one of the most powerful and immediate links in all of corporate finance. A well-designed compensation plan creates wealth. A poorly designed one destroys it. Let's quantify the impact. Consider Company A, run by an owner-CEO. Their compensation is a low salary and a massive, personally purchased stock holding. They are incentivized to think about increasing the per-share intrinsic value of the business over the next decade. When the company generates excess cash, this CEO will only buy back stock when it is trading below their conservative estimate of its intrinsic value. This is accretive to the remaining shareholders. It is a direct transfer of wealth to them. If they make an acquisition, it will be a carefully considered purchase of a great business at a fair price, funded with cash, leading to a high return on invested capital. This adds directly to the company's long-term earning power. The financial statements of Company A will be characterized by a rising ROIC, a pristine balance sheet with little goodwill, and a steadily declining share count over time. The stock price will, over the long run, follow the upward trajectory of the company's intrinsic value. Now consider Company B, run by a manager-CEO, a stock option gambler. Their compensation is loaded with stock options that vest based on hitting a certain stock price target. Their brain is now wired to do one thing: get the stock price up, by any means necessary. When the company generates excess cash, this CEO will be tempted to announce a massive share buyback program, even if the stock is trading at an all-time high. Why? Because the buyback provides demand for the stock, pushing up the price, and the reduction in share count provides a cosmetic boost to EPS. This action is dilutive to long-term shareholders. It is using their capital to buy an asset, their own stock, at an inflated price. It is a direct transfer of wealth from the CEO who is cashing in their options. If this CEO makes an acquisition, it is likely to be a transformational deal designed to excite the market and create a narrative that drives the stock price higher, with little regard for the price paid or the strategic fit. The financial statements of Company B will tell a story of value destruction. You'll see a declining ROIC as they make poor acquisitions. You'll see the goodwill and debt on the balance sheet explode. You'll see a share count that doesn't meaningfully decrease, because the buybacks are just enough to offset the flood of new shares being issued to executives through their option grants. The stock price of Company B might experience short, sharp rallies based on hype and financial engineering, but over the long run, it will stagnate or fall as the underlying business fundamentals deteriorate. The lesson is clear. Analyzing executive compensation is not an optional, soft part of due diligence. It is the most direct way to predict the future financial trajectory of a business. It allows you to see whose interests are truly being served and to ensure that your capital is managed by a partner, not an employee who is simply looking for the quickest way to cash out at your expense. The third pillar in identifying the true owner-CEO is found not in their actions with capital or their pay stub, but in their words. Communication is a window into the soul of a business. The way a CEO speaks and writes to their shareholders reveals their fundamental view of the relationship. Does they see you as an intelligent partner in a long-term enterprise, deserving of candor and clarity? Or do they see you as a fickle and unsophisticated audience to be managed, manipulated, and sold a story? An owner-CEO communicates with a relentless focus on business reality, admitting mistakes, explaining complexities in simple terms, and treating the annual report as a document of accountability. A manager-CEO uses the language of promotion, jargon, buzzwords, and optimistic platitudes designed to obscure problems and manage perceptions. In the long run, the truth always wins out, and the CEOs who communicate with honesty and transparency build a foundation of trust that is itself a priceless corporate asset. The foundational anecdote for this principle is, without question, the collected body of Warren Buffett's annual letters to the shareholders of Berkshire Hathaway. These letters are not just financial reports. They are masterpieces of business education and paragons of corporate transparency. For over 50 years, Buffett has used his annual letter to communicate with his partners, and his style stands in stark, brilliant contrast to the typical corporate boilerplate. First, there is the legendary candor. Buffett begins many of his letters by discussing his mistakes. He openly details investments that went wrong, acquisitions that failed to meet his expectations, and errors in judgment he made during the year. In his 1989 letter, after a costly mistake involving the purchase of U.S. Air preferred stock, he didn't hide or spin the story. He wrote, "I have no special insights in this area. I have an 80-year-old partner, Charlie Munger, to help me with tough problems, and 90,000 shareholders to watch my every move. I'm not playing with my own money. It's all there, what can I do? It's a big help to me to have Charlie. It's a big help to me to have a board of directors that's not on my side." I would say that what you do in a situation like this is you call your partner and say, "I made a mistake." This level of honesty is unheard of in corporate communications. It treats shareholders like adults who understand that business involves mistakes. It builds immense credibility so that when Buffett does discuss his successes, they are believed without question. Second, there is his use of plain English. The letters are famously free of jargon. He explains complex financial concepts like float in the insurance business or the economics of share buybacks using simple analogies and clear, concise prose. He believes that if you cannot explain something simply, you probably don't understand it well enough. He writes the letters himself, ensuring that his authentic voice and clarity of thought shine through. Contrast this with a typical annual report, which is often an unreadable document stitched together by committees of lawyers, accountants, and public relations professionals, designed to meet disclosure requirements while revealing as little as possible. Third, Buffett focuses on what truly matters: the long-term, per-share intrinsic value of the business. He educates his shareholders on how to think about Berkshire's value, consistently using the metric of per-share book value growth as a flawed but consistent proxy. He rarely, if ever, discusses the quarterly fluctuations of the stock price. He is training his shareholders to ignore the short-term noise of the market and focus on the underlying performance of the business. He is, in effect, trying to create the ideal shareholder base for a long-term compounding machine, investors who are patient, rational, and aligned with his owner's mindset. Reading a Berkshire Hathaway annual letter feels like having a frank, intelligent conversation with a trusted partner who is leveling with you about your shared investment. Reading most other annual reports feels like being subjected to a slick marketing presentation. This difference in communication style is not superficial. It is a direct reflection of the CEO's fundamental respect for their shareholders and their commitment to long-term value creation. The psychological principle that explains why this communication style is so important is known as the narrative fallacy. Coined by Nassim Nicholas Taleb in his book The Black Swan, the narrative fallacy describes our vulnerability to overly simplistic and emotionally compelling stories. The human brain is not wired to process raw data and probabilities. It is wired to understand the world through narratives. We crave stories with clear cause and effect relationships, heroes and villains, because they help us make sense of a complex and random world. The manager CEO, the promoter CEO, instinctively or deliberately exploits this cognitive bias to their advantage. They know that a good story is more powerful than a spreadsheet. Instead of presenting the unvarnished facts of the business, they craft a narrative. It might be a story of disruption, where their plucky company is the David fighting the industry Goliaths. It might be a story of transformation, where a magical new strategy is going to unlock untold riches. They use buzzwords like synergy, platform, ecosystem, and AI-driven, not because they have precise meanings, but because they sound futuristic and exciting. They fill their earnings calls and investor presentations with optimistic projections and carefully selected anecdotes that support their narrative, while conveniently omitting any data that might contradict it. This taps directly into our confirmation bias, our tendency to seek out and favor information that confirms our existing beliefs. If we want to believe in the company's success story, the promoter CEO will feed us all the evidence we need. The owner CEO, on the other hand, wages a constant war against the narrative fallacy. Warren Buffett's communication style is a deliberate attempt to deprogram his shareholders from this very bias. By focusing on numbers, admitting mistakes, and discussing the boring long-term realities of business, he is forcing his readers to engage their rational, analytical minds rather than their emotional, story-driven minds. His candor about failures actively shatters the simplistic hero narrative that most CEOs try to cultivate. He is essentially telling his partners, business is hard, it's messy, we will make mistakes. There is no simple story here. We must stick to the facts and the numbers. This approach is far less exciting in the short term. It doesn't generate the same kind of breathless media coverage or speculative fervor in the stock. But over the long term, it builds a foundation of profound and unshakable trust. Investors in companies run by promoter CEOs are riding an emotional roller coaster, their conviction rising and falling with the latest chapter in the corporate story. When the story inevitably hits a snag, when reality intrudes on the narrative, these investors panic and sell because their belief was founded on a flimsy story, not on a deep understanding of the business fundamentals. Investors in companies run by owner CEOs who communicate with candor have a conviction that is forged in reality. They understand the risks, they know the challenges, and they trust the management to navigate them honestly. This creates a stable, long-term shareholder base, which is a significant competitive advantage in itself. It allows the CEO to make rational, long-term decisions without having to worry about spooking a fickle market. Understanding the narrative fallacy allows you to inoculate yourself against the seductive but dangerous stories spun by promoter CEOs, and to appreciate the deep value of the boring, fact-based communication of a true owner. To put this principle into practice, you need a mental model for analyzing corporate communications. Let's call it the candor audit. This is a systematic way to read an annual report, listen to an earnings call, or review an investor presentation to gauge the quality and honesty of the CEO's communication. It consists of a few key questions you must ask yourself. First, do they talk about their mistakes? This is the single most important test. Look for a dedicated section in the annual letter where the CEO discusses what went wrong during the year. Is it a genuine admission of an error in judgment, or is it a non-apology apology that blames external factors like the economy or a competitor? True owners take responsibility. Managers make excuses. Second, do they discuss the competition and the risks? A promoter CEO will paint a picture of a world with no credible threats, where their company has an insurmountable lead. An owner CEO will provide a sober, realistic assessment of the competitive landscape. They will talk about how their toughest competitors are getting stronger and what they are doing to stay ahead. They will openly discuss the key risks to the business. This demonstrates that they are paranoid in a healthy way and are not drinking their own Kool-Aid. Third, is the language simple and direct, or is it filled with jargon? Pull out a highlighter. Go through the first few pages of the annual letter. Highlight every piece of corporate jargon or meaningless buzzword you find. If the page is covered in yellow, you are likely dealing with a manager who is trying to obscure reality. If the page is clean, you are likely dealing with an owner who is trying to clarify it. Fourth, are the metrics consistent and focused on value? Does the CEO use the same key performance indicators year after year, allowing for easy comparison? Or do they change the goalposts, highlighting whichever metric happens to look good in a particular year? Look for a consistent focus on per-share metrics, like earnings per share, book value per share, or free cash flow per share. A focus on aggregate numbers, like total revenue, can hide underlying problems like shareholder dilution. Fifth, how do they answer tough questions? During the Q&A portion of an earnings call, listen carefully to how the CEO responds to challenging questions from analysts. Do they answer the question directly, or do they pivot to a pre-rehearsed talking point? Do they admit when they don't know the answer, or do they bluster their way through? A willingness to say "I don't know" is a sign of intellectual honesty and a hallmark of a great leader. By running every piece of communication through this 5-part candor audit, you can develop a remarkably accurate portrait of the CEO's character and their approach to shareholder partnership. It's a powerful tool of due diligence that goes far beyond the numbers. To truly understand the value of candid communication, we must examine the antithesis, the path of the promoter CEO, and the disastrous consequences of their narrative-driven approach. The promoter CEO is a master storyteller. They are often charismatic, visionary, and incredibly persuasive. They are selling a dream, and for a time, the market often buys it wholesale. But their narratives are built on a foundation of sand, and when the tide of reality comes in, the entire structure collapses, taking shareholder capital with it. The story of WeWork and its founder and CEO, Adam Neumann, is a modern epic of the promoter CEO archetype. Neumann was a brilliant salesman. He wasn't selling office space. He was selling a revolution in the way people work and live. He spoke of elevating the world's consciousness. He used a new corporate metric, community-adjusted EBITDA, which was essentially a measure of profits before all the costs were taken out. In other words, a complete fiction. But the story was incredibly compelling, especially in a market hungry for the next big tech disruption. He convinced sophisticated investors, most notably SoftBank, to pour billions of dollars into the company at ever more ludicrous valuations, reaching a peak of $47 billion. The communication from Neumann and WeWork was a masterclass in the narrative fallacy. The company's S-1 filing, the document required for its planned IPO, was not a sober business document. It was a bizarre, New Age manifesto. It was filled with grandiose statements and photos of happy millennials collaborating in beautifully designed spaces. The actual business model, long-term leases on expensive real estate, liabilities, being sublet on short-term contracts to startups and freelancers, unreliable assets, was buried under layers of aspirational jargon. A simple candor audit would have set off every alarm bell. There was no admission of mistakes, only relentless positivity. The risks of a real estate downturn or a tech bust were downplayed. The language was anything but simple, filled with made-up metrics and buzzwords. But investors were caught up in the story, the cult of personality around the charismatic founder. The crash, when it came, was swift and brutal. Public market investors, upon reviewing the S-1, balked at the nonsensical financials and questionable corporate governance. The IPO was pulled. The $47 billion valuation collapsed by over 90%. Adam Neumann was forced out, though, with a golden parachute worth over $1 billion. Thousands of employees lost their jobs, and the investors who had bought into the narrative suffered catastrophic losses. This is the ultimate fate of companies run by promoter CEOs. Their focus on narrative over reality leads them to build unsustainable businesses. Their communication style attracts short-term speculators rather than long-term partners. And when the story breaks, the fall is always devastating. The retail investor who trains themselves to be immune to these seductive narratives, who insists on the boring, candid communication of an owner-CEO, will protect themselves from these entirely avoidable disasters. The financial connection between a CEO's communication style and the long-term performance of a stock is profound and direct. Transparent, candid communication builds trust, and trust is a quantifiable financial asset. When a company is run by a CEO who communicates like an owner, it attracts a specific type of investor, the long-term, patient, value-oriented shareholder. This quality shareholder base, as it's sometimes called, is incredibly valuable. These investors are less likely to sell in a panic during a market downturn or a temporary business setback. This stability reduces the volatility of the stock and allows the management team to focus on making rational, long-term decisions without being held hostage by the whims of a flighty market. A lower stock volatility can also lead to a lower cost of capital for the company. When it needs to raise money, either through debt or equity, it can often do so on more favorable terms because lenders and new investors have a higher degree of trust in the management and the information they provide. Conversely, a company run by a promoter CEO who communicates with hype and obfuscation attracts a different crowd: short-term traders, momentum chasers, and speculators. This shareholder base is inherently unstable. They are not invested in the long-term fundamentals of the business. They are betting on the continuation of the story. As soon as the narrative falters, they will dump the stock en masse, causing extreme volatility and a potential price collapse. This financial instability can become a self-fulfilling prophecy. The falling stock price makes it more expensive to raise capital. It can damage employee morale and make it harder to attract talent. It can spook customers and suppliers. The lack of trust created by the CEO's communication style creates real, tangible financial costs. Consider the balance sheet. A company with transparent communication is far less likely to be hiding ticking time bombs. The candor of an owner-CEO means that problems are disclosed early and openly, allowing the market to price them in rationally. The opaque communication of a promoter CEO often serves to hide underlying issues, like the unsustainable business model of WeWork or the accounting fraud at Sunbeam. When these issues are finally revealed, the resulting stock price collapse is not just a correction, it is a cataclysm, as the market is forced to reprice years of hidden risks all at once. By choosing to invest only with CEOs who pass the candor audit, you are doing more than just picking a good communicator. You are choosing to invest in a company with a more stable shareholder base, a lower cost of capital, and a significantly lower risk of a catastrophic, trust-related collapse. You are aligning yourself with the financial power of transparency. The fourth pillar of the owner-CEO mindset is a concept that is deeply countercultural in a world that celebrates boundless ambition and constant action. It is the principle of the circle of competence and the corresponding courage to say no. An owner's CEO has a deeply ingrained understanding of what their business does well, where its competitive advantages lie, and, just as importantly, where they don't. They operate with ruthless discipline within this circle, allocating capital only to opportunities they fully understand. They possess the intellectual humility and personal fortitude to reject tempting ideas, popular trends, and ego-gratifying deals that fall outside of it. A manager CEO, on the other hand, often feels immense pressure from the board, from Wall Street, and from their own ego to always be doing something, to be pursuing growth in every direction. This often leads them to stray outside their area of expertise, a phenomenon Charlie Munger colorfully calls diversification, diversifying into businesses they don't understand, which almost inevitably destroys value. The discipline to stay within a well-defined circle of competence is a quiet but incredibly powerful sign of a leader who is focused on long-term, sustainable value creation, not on building a sprawling, incoherent empire. The foundational anecdote for this pillar is one of Warren Buffett's most famous and, at the time, most criticized decisions: his refusal to invest in technology stocks during the dot-com bubble of the late 1990s. As the internet boom reached a fever pitch, the stock market was gripped by a speculative mania unlike anything seen in decades. Companies with no profits, no revenues, and often no viable business plan were going public and seeing their stock prices soar to astronomical heights. It was a new paradigm, the experts claimed. Old metrics like earnings and book value were irrelevant. It was all about eyeballs, clicks, and first-mover advantage. During this period, Warren Buffett and Berkshire Hathaway were widely ridiculed. They were dismissed as dinosaurs, relics of an old economy who just, quote, didn't get it. Magazine covers famously depicted Buffett in a horse and buggy watching a sports car labeled technology race past him. The pressure on him to abandon his principles and join the party was immense. Berkshire stock actually underperformed the S&P 500 significantly in 1999. As technology stocks went parabolic, shareholders grumbled. Pundits declared that his time had passed. Yet Buffett remained resolute. His reasoning was devastatingly simple and a perfect illustration of the circle of competence principle. He explained in his annual letters and at his shareholder meetings that he simply did not understand the technology businesses. He couldn't confidently project the cash flows of these companies 10 or 20 years into the future. He couldn't identify which ones had a durable, long-term competitive advantage or a moat and which ones were just temporary beneficiaries of the mania. He knew that the valuations were predicated on assumptions about future growth that were, for him, pure speculation. Because he could not operate within his circle of competence, he did nothing. He said no. He chose to sit patiently with cash rather than gamble in an area he didn't understand. This required immense courage and conviction. It meant looking foolish in the short term. It meant enduring the taunts of a market that believed he was past his prime. Then, in the spring of 2000, the bubble burst. The Nasdaq Composite Index, which had been the epicenter of the tech boom, collapsed by nearly 80% over the next 2 years. Companies that had been worth billions saw their valuations wiped out entirely. Trillions of dollars of speculative wealth vanished. And Berkshire Hathaway, which had been derided for its caution, had its cash hoard intact. Buffett was able to deploy that capital during the ensuing downturn, buying wonderful businesses at bargain prices. His discipline not only saved his shareholders from catastrophic losses, but also positioned them to profit immensely from the folly of others. This story is the ultimate testament to the power of intellectual humility. It demonstrates that in investing and in business, it is not what you know that gets you into trouble, but what you think you know for sure that just ain't so. The courage to admit what you don't know and to act accordingly is a hallmark of a true owner. The psychological forces that drive a manager/CEO to stray outside their circle of competence are powerful and insidious. The first and most obvious is the overconfidence bias. A CEO who has experienced a string of successes, who is celebrated by the media and revered by their employees, can easily begin to believe their own hype. They start to think they have a golden gut, an infallible intuition that can be applied to any industry. This cognitive error leads them to underestimate the challenges of entering a new business and to overestimate their own ability to succeed in it. They forget that their success in their core business was based on decades of accumulated, domain-specific knowledge, not on some generalized business acumen. They venture into a new field where they are a novice, but their overconfidence prevents them from seeing it. The second powerful force is the fear of missing out, or FOMO. This is particularly potent during speculative bubbles or periods of rapid technological change. When a new trend emerges, whether it's the internet in the late 90s or perhaps artificial intelligence today, there is immense pressure on every CEO to have a story for how their company is going to capitalize on it. Analysts ask about it on earnings calls. The board of directors wants to see a strategy. Competitors are issuing press releases. The fear of being perceived as behind the curve, of being the one company that missed the next big thing, can be overwhelming. This social pressure can compel a perfectly rational CEO to make an ill-advised acquisition or launch a costly new initiative in a field they know nothing about, simply to signal to the market that they are innovative. An owner-CEO, one with deep skin in the game, has a psychological anchor that helps them resist these forces. Their focus on the permanent preservation of their capital acts as a powerful counterbalance to the siren song of overconfidence and FOMO. The potential pain of losing their own money in a foolish venture far outweighs the temporary ego boost of being seen as a visionary or the social comfort of following the herd. They have the psychological fortitude to endure looking foolish in the short term in order to be right in the long term. This inner strength, this ability to resist powerful cognitive biases, is a rare and invaluable leadership trait. To apply this principle to your own investment analysis, you can use a mental model we'll call competence mapping. This is a straightforward technique to visually assess whether a CEO's strategy is aligned with the company's historical strengths. First, take a piece of paper and draw a large circle in the center. Inside this circle, you will define the company's core circle of competence. To do this, you need to answer a few questions by studying the company's history. For the past 10 or 20 years, how has this company primarily made its money? What is its core skill? Is it low-cost manufacturing? Is it world-class brand marketing? Is it innovative product design? Is it a deep and efficient distribution network? Be specific and honest. The circle of competence is defined by a long track record of demonstrated excellence, not by a company's aspirations. For example, Coca-Cola's circle of competence is brand management, marketing, and global distribution of beverages. It is not, for instance, movie production, even though they famously tried and failed at that in the 1980s. Second, once you have clearly defined the core competence inside the circle, you must map the CEO's recent major strategic decisions. Look at the company's major capital expenditures, acquisitions, and new business ventures over the last 5 years. For each one, place a dot on your map. If the decision falls squarely within the company's historical circle of competence, for example, if Coca-Cola buys another beverage brand, place the dot inside the circle. If the decision falls outside of it, for example, if a successful railroad company decides to acquire a software startup, place the dot far outside the circle. Third, analyze the map. Is the CEO focusing their capital and energy on deepening the company's existing competitive advantages, on making the circle itself stronger and wider? Or are the dots scattered all over the page, indicating a pattern of diversification and a lack of strategic focus? An owner-CEO's map will show a tight cluster of dots within or very near the core circle. They are sticking to their knitting, doubling down on what they do best. A manager-CEO's map will often look like a shotgun blast, with investments in unrelated fields that reflect a chase for trends rather than a disciplined strategy. This simple visual exercise can cut through the strategic jargon in an annual report and give you a clear, immediate picture of the CEO's discipline and their respect for the limits of their own expertise. It's a powerful due diligence tool for separating focused value creators from unfocused empire builders. The path of the 99%, the antithesis of this disciplined approach, is the diversification trap. This is the path taken by the manager-CEO who, driven by overconfidence or fear, believes that the solution to every problem is to expand into something new. They see that their core business is maturing, and instead of finding innovative ways to improve it, they use its cash flows to buy a random assortment of unrelated businesses. The result is a conglomerate, a holding company with a hodgepodge of disconnected operations that the central management team cannot possibly understand or add value to. This strategy almost always leads to the destruction of shareholder wealth. The classic cautionary tale of diversification is the story of ITT Corporation under the leadership of its legendary CEO, Harold Janine, from the 1960s to the 1970s. Janine was a brilliant and driven manager, obsessed with financial controls and smooth earnings growth. ITT began as a simple international telephone company, but under Janine's leadership, it transformed into the quintessential conglomerate. He went on an acquisition binge of epic proportions, buying hundreds of companies. By the end of his tenure, ITT owned everything from Sheraton Hotels and Avis Rent-A-Car to Hartford Insurance and Hostess Twinkies. Janine's logic was that his superior management systems could be applied to any business to improve its performance. This was the ultimate expression of the overconfidence bias. He believed his circle of competence was, in fact, the entire economy. For a while, during the conglomerate craze of the 1960s, the market applauded his actions. ITT's stock performed well, and Janine was hailed as a management visionary. He was famous for his grueling financial review meetings and his insistence on no surprises. But the empire was built on a flawed premise. A small team of executives at a corporate headquarters in New York could not possibly have the detailed, industry-specific knowledge needed to effectively manage such a diverse array of businesses. They couldn't add any real value to a hotel chain or a baking company. All they could do was impose financial controls from afar. Eventually, the complexity became overwhelming. The individual businesses stagnated, unable to compete effectively against more focused, nimble competitors. The market began to realize that the whole was worth less than the sum of its parts. ITT's stock entered a long period of decline, and the company was eventually broken up, its various pieces sold off or spun out. The great empire that Harold Janine had built was dismantled because it had no underlying business logic. It was a monument to the idea that growth for its own sake, untethered from a circle of competence, is a recipe for disaster. This story serves as a timeless warning to investors. When you see a CEO trying to be a jack of all trades, you can be almost certain they will be a master of none, and your capital will pay the price. The financial connection between operating within a circle of competence and generating superior returns is direct and quantifiable. A business that consistently stays within its circle of competence is able to build and maintain a high return on invested capital, ROIC. Why? Because it is constantly reinvesting its profits back into the areas where it has a genuine, sustainable, competitive advantage. When a company like Coca-Cola spends $1 on advertising, it is leveraging its world-class brand and marketing expertise. That dollar is likely to generate a much higher return than if it were spent by a smaller, less skilled competitor. When a low-cost manufacturer like Nucor Steel invests $1 billion in a new, more efficient mill, it is leveraging decades of specialized operational knowledge. That investment is almost certain to be more profitable than a similar investment made by a company with no experience in steel manufacturing. This focus creates a virtuous cycle. High returns generate more cash, which is then reinvested at high rates of return, leading to a powerful compounding of intrinsic value over time. On the financial statements, this shows up as a consistently high and stable ROIC, strong free cash flow generation, and expanding profit margins. Now, let's examine the financial consequences of diversification. When a company strays outside its circle of competence, it is, by definition, investing in a business where it has no competitive advantage. When ITT bought Avis Rent-A-Car, it had to compete with Hertz, a company that had spent its entire existence focused on one thing: renting cars. ITT's management, skilled in telecommunications, had nothing to add. They were amateur car renters competing against professionals. As a result, the returns on the capital they invested in Avis were destined to be mediocre at best. When a company builds a conglomerate of unrelated businesses, the overall ROIC of the corporation becomes a blended average of all its disparate parts, and it is inevitably dragged down by the low-return ventures outside its core competence. This leads to a phenomenon known as the, quote, conglomerate discount. The stock market recognizes that the company is a complex, inefficient collection of assets that would be worth more if they were broken up and run as focused, independent businesses. As a result, the market assigns a valuation to the conglomerate stock that is lower than the sum of its individual parts. The CEO's attempt to create value through diversification has had the exact opposite effect. It has destroyed it. On the financial statements, diversification shows up as a declining or chronically low ROIC, bloated corporate overhead costs needed to manage the complexity, and often a heavy debt load incurred to finance the ill-advised acquisitions. By using the competence mapping model, you can predict this financial decay long before it becomes obvious to the wider market, allowing you to avoid the value destruction of the diversification trap and align your capital with the focused, compounding machines run by true owner CEOs. We arrive now at the fifth and final pillar, the one that encapsulates the fundamental spirit of the owner CEO. It is a fanatical devotion to the business itself, not to its stock price. A true owner CEO is obsessed with the long-term operational health and competitive positioning of their enterprise. They spend their days thinking about their customers, their products, their employees, and their competitors. They are maniacally focused on widening the company's moat, the sustainable competitive advantage that protects it from rivals. The company's stock ticker is, to them, a distracting and often irrational sideshow. A manager CEO, by contrast, is often obsessed with the stock price. Their office television is tuned to the financial news channels. They check the stock's quote multiple times a day. Their mood, and more importantly, their decisions, are heavily influenced by the daily, weekly, and quarterly gyrations of the market. This seemingly subtle difference in focus is, in fact, a chasm. It separates the leader who is building an enduring institution from the one who is playing a short-term expectations game. The quintessential foundational anecdote for this pillar is the story of Rose Blumpkin, the legendary founder of the Nebraska Furniture Mart. Mrs. B, as she was known, was a Russian immigrant who arrived in America unable to speak a word of English. In 1937, with a loan of $500, she started a small furniture store in the basement of her husband's pawn shop in Omaha, Nebraska. Her business philosophy was brutally simple and devastatingly effective: sell cheap and tell the truth. She was relentlessly, fanatically focused on offering her customers the best possible prices. She bought in bulk, negotiated fiercely with suppliers, and maintained an incredibly low-cost operation. She worked grueling hours, 7 days a week, her life consumed by the singular goal of providing more value to her customers than any competitor could. She wasn't building a business to flip it or to hit a quarterly earnings number. She was building a legacy, an institution that was an extension of her own values. By the 1980s, the Nebraska Furniture Mart was the single largest home furnishing store in the United States, generating hundreds of millions of dollars in sales, all from one location in Omaha. It had become a local legend, famous for its massive selection and impossibly low prices. In 1983, Warren Buffett decided to buy the company for Berkshire Hathaway. The negotiation was as legendary as Mrs. B herself. Buffett walked into her office and simply asked, "How much do you want for the store?" She scribbled a number on a piece of paper, $60 million. Buffett glanced at it and said, "Okay, I'll buy it." He didn't ask to audit the books. He didn't bring in a team of accountants or lawyers for months of due diligence. The entire deal was sealed with a 2-page contract and a handshake. Why would the famously meticulous Buffett do this? Because he knew he was buying a business run by the ultimate owner-operator. He had observed Mrs. B's fanatical devotion to the business itself for years. He knew her focus wasn't on financial engineering or managing Wall Street's expectations. Her focus was on her customers, her inventory, and her competitors. She was obsessed with widening her moat, which was her low-cost advantage. Buffett knew that a business built with that kind of intense, owner-driven focus on operational excellence was almost certain to be immensely valuable, regardless of what the formal financial statements said. After Berkshire bought the company, Mrs. B, then nearly 90 years old, continued to work, still riding her electric cart around the showroom floor, haggling with customers and berating suppliers. Her life was the business. The stock price of Berkshire Hathaway was an abstraction she had little interest in. She is the perfect embodiment of this final pillar, a leader whose entire being is dedicated to the real-world success of the enterprise, not the ephemeral judgment of the stock market. The psychological trap that the manager-CEO falls into is a combination of two powerful cognitive biases: the focusing illusion and myopic loss aversion. The focusing illusion states that nothing in life is as important as you think it is, while you are thinking about it. The stock ticker is a perfect trigger for this illusion. It is a single number, updated every second, that purports to represent the value of the entire company. It is salient, easily accessible, and constantly changing. For a CEO whose compensation and reputation are often tied to this number, it becomes an object of intense focus. They begin to believe that the most important thing they can do as a leader is to make this number go up in the short term. This illusion causes them to lose perspective. They forget that the stock price is just a noisy, often irrational, short-term indicator of market sentiment. They start to confuse the map, the stock price, with the territory, the underlying business. All of their strategic thinking becomes oriented around managing this single volatile number. This is then compounded by myopic loss aversion. We know from our earlier discussion that people feel losses more acutely than gains. Myopic loss aversion is the tendency for this to be amplified when we evaluate outcomes frequently. A CEO who checks their stock price every day will experience the pain of numerous small declines. This constant stream of negative feedback can lead to a state of chronic anxiety and risk aversion. It can make them unwilling to make bold, long-term investments that might cause a temporary dip in earnings and a corresponding drop in the stock price, even if those investments are crucial for the company's future. They become paralyzed by the fear of a negative reaction from the market. An owner-CEO, like Mrs. B, is psychologically insulated from this trap because they are simply not focused on the ticker. Their attention is directed at the things that create long-term value: product quality, customer satisfaction, operational efficiency. Their evaluation period is not the next quarter, but the next decade. They are playing a different game, and their psychological state reflects that. They are focused on building a cathedral, while the manager-CEO is frantically trying to patch the cracks in the church wall before the Sunday service. This difference in focus, driven by these deep psychological biases, is the ultimate determinant of long-term success. To operationalize this principle, you need a mental model to evaluate whether a CEO's actions are focused on the business or the stock. Let's call it the moat deepening checklist. When you analyze a company, instead of focusing on the quarterly earnings reports, you should look for evidence that the CEO is taking concrete actions to widen the company's long-term competitive advantage, or moat. Your checklist should include the following questions. First, are they investing in their brand? A strong brand allows a company to charge premium prices and fosters customer loyalty. Look for consistent and intelligent spending on marketing and advertising that strengthens the brand's identity, not just short-term promotional activity. Second, are they creating switching costs? Are they making it harder for customers to leave? This could be through technology platforms that integrate deeply into a customer's workflow, or through loyalty programs that reward repeat business. A CEO focused on the moat is always thinking about how to make their product or service stickier. Third, are they achieving network effects? For some businesses, the value of the service increases as more people use it, like a social media platform or a credit card network. Look for strategies that are explicitly designed to grow the user base in a way that strengthens this effect for everyone, creating a winner-take-all dynamic. Fourth, are they relentlessly driving down costs? A sustainable cost advantage like Mrs. B's is one of the most durable moats. Look for evidence of investment in efficiency, automation, and supply chain optimization. Is the CEO obsessed with stripping out unnecessary costs to provide more value to the customer? Fifth, are they investing in innovation and protecting intellectual property? Is the company spending on R&D to create the next generation of products? Are they securing patents and trade secrets to protect their unique advantages? A moat-focused CEO is willing to make long-term bets on innovation, even if they don't have a guaranteed short-term payoff. By evaluating a CEO's actions through the lens of this moat-deepening checklist, you shift your own focus from the noisy quarterly earnings game to the long-term game of value creation. You begin to see the company as an owner would, judging the CEO not on their ability to talk a good game to Wall Street, but on their tangible actions to build a better, stronger, more defensible business. The antithesis of the moat-deepening owner is the CEO, who is trapped in the quarterly earnings game. This is the path of the 99% of public company leaders. Their world revolves around a 4-times-a-year ritual, the earnings release, and the subsequent conference call with Wall Street analysts. The pressure to meet or beat the consensus analyst estimate for quarterly revenue and earnings per share is immense. A miss, even by a single penny, can lead to a sharp sell-off in the stock, negative press coverage, and angry calls from board members. This relentless short-term pressure forces CEOs to make decisions that are often deeply irrational and destructive to long-term value. To win the quarterly earnings game, a CEO will do things that no rational business owner would ever do. We've discussed some of these tactics before, but they bear repeating in this context. They will cut the R&D budget towards the end of a quarter to make the numbers look better, sacrificing future innovation for a tiny, immediate profit boost. They will delay essential maintenance on factories and equipment, pushing a real cost into the future to create an accounting gain today. They will pressure their sales force to offer deep discounts to pull sales from the next quarter into the current one, cannibalizing their own future growth. In extreme cases, this pressure can lead to outright fraud. The Wells Fargo account fraud scandal is a tragic example. Under immense pressure from leadership to meet aggressive daily sales quotas, a micro version of the quarterly earnings game, thousands of employees resorted to opening millions of fake bank and credit card accounts in customers' names without their consent. The short-term metrics looked fantastic. The executives in charge were handsomely rewarded. But the long-term damage to the company's reputation, its most valuable asset, was catastrophic, resulting in billions of dollars in fines and a permanent loss of customer trust. The quarterly earnings game is a value-destroying treadmill. It forces a company to focus on managing perceptions rather than reality. It elevates the importance of short-term accounting results over long-term business health. The CEO who plays this game is not serving the shareholders. They are serving the short-term expectations of Wall Street analysts. The retail investor who learns to see through this game, who learns to judge a company by the checklist of moat-deepening actions rather than its ability to hit a quarterly number, can avoid these ticking time bombs and align themselves with businesses that are built to last. The direct financial connection between a CEO's focus and long-term value is the essence of compounding. The financial impact of a moat-deepening mindset versus a quarterly game mindset is the difference between an exponential growth curve and a flat line. Let's quantify it. Imagine an owner's CEO who identifies a $1 million R&D project that has a high probability of creating a new product feature. This project will depress earnings by $1 million in the current year, causing them to miss Wall Street's quarterly estimates. The stock might even fall 10% on the news. But if that new feature extends the life of their product and strengthens their competitive moat, it might generate an extra $10 million in profits over the next decade. The CEO has sacrificed a small amount of short-term market approval for a massive long-term gain in intrinsic value. They have planted an oak tree. Now consider the manager CEO playing the quarterly game. To beat the earnings estimate by $1 million, they cut that same R&D project. The stock pops 5% on the good news. The CEO is praised for their cost discipline, but they have just sacrificed $10 million of future profit for a one-time, $1 million accounting gain. They have eaten their seed corn. This choice, repeated over and over again, quarter after quarter, is how great companies decline. It is a slow, almost invisible erosion of long-term value in exchange for a series of fleeting short-term victories. On the financial statements, the company playing the quarterly game might show smooth, predictable earnings growth for a time, but you will see its gross margins begin to decline as its products become less competitive. You will see its capital expenditures dry up. You will see its revenue growth eventually stagnate and then fall. The company focused on moat deepening might have lumpier, less predictable earnings in the short run, as it makes big investments. But over a 5 or 10-year period, you will see its market share grow, its margins expand, and its revenue growth accelerate. The stock price will ultimately follow these superior business fundamentals. Your job as an investor is to have the patience and the wisdom to distinguish between the two. By focusing on the CEO's fanatical devotion to the business itself, you are betting on the unstoppable power of long-term compounding over the seductive but ultimately empty illusion of short-term market gratification. You have just spent this time absorbing a framework that separates the most successful investors from the crowd. You've done more than just learn a new tactic for stock analysis. You have fundamentally upgraded your mental operating system for evaluating the most critical component of any business, its leadership. You now possess the ability to look past the smoke and mirrors of the celebrity CEO and the short-term noise of the market. You can now identify the quiet, powerful signs of the true owner-operator, the disciplined capital allocator, the properly incentivized partner, the candid communicator, the focused expert, and the business-obsessed fanatic. This is a formidable tool, an intellectual moat that will protect your capital and empower you to compound it for decades to come. You have made a significant investment in your financial education, and the dividends from this knowledge will pay out for the rest of your life. But it is crucial to understand that what you have just mastered, as powerful as it is a single, vital piece of a much larger, interconnected system. Warren Buffett's success is not built on one mental model, but on a latticework of them, each one reinforcing and strengthening the others. The ability to identify an owner-CEO is the first step, but to truly harness its power, you must connect it to the principles of valuation, competitive advantage, and behavioral finance. Knowing you have a great jockey is useless if you don't know how to value the horse. Today, you have learned how to analyze the character and competence of management. But what if the business they are managing, for all their skill, is in a declining industry with no competitive moat? How do you weigh a brilliant CEO in a mediocre business against a competent CEO in a magnificent one? These are not separate questions. They are integrated parts of a single, cohesive philosophy of wealth creation. The video that is now appearing on your screen is not a random suggestion. It is the next piece of the map. It is the crucial link that connects the who of management analyses to the what of business analysis. It takes the principles of leadership we have just uncovered and fuses them with the tools needed to dissect a company's competitive position and calculate its intrinsic value. Think of it as the other half of the equation you need to solve. Mastering one without the other is like having a powerful engine without a chassis, or a brilliant pilot without a plane. The journey to becoming a truly sophisticated investor, one who can confidently navigate any market condition, requires the assembly of this complete mental arsenal. The choice is yours. You can stop here, with one powerful weapon in your toolkit. Or you can choose to continue the ascent, to forge the next link in the chain, to complete the latticework of models that will serve as your impenetrable fortress in the world of investing. This is not about watching another video. This is a decision about who you want to become. If you are serious about achieving financial freedom, if you are committed to mastering this craft, then the next step is not a choice but a necessity. Click and continue your journey.